fractional stock investing is super helpful and beneficial if you are first starting out because it allows you to invest with less money in the companies that you wish to invest in. Now, a fractional stock investment means that you are purchasing a fraction of a share. And oftentimes this means that you're trading a CFD. Now, a lot of times on a lot of these brokerages, they don't really explain very well what a CFD is or really show that you're even trading a CFD. Like IQ Options, which does CFDs, they have like a little thing right here. It says CFDs, and they have a little box that says it's a CFD. Now, a CFD means that you are not technically ever owning the asset. So you won't be getting some of the benefits of owning the asset if it is a dividend asset, which a lot of corporations are not dividend assets. But it does give you the opportunity to say for Amazon, Amazon sells for over $1,000. Now I am able to, with this, go right here, and I'm able to not only get leverage of 5%. I mean, not 5%, but a 5-to-1 leverage right here. I'm able to purchase part of the asset for less money. I could buy, say, just $10 worth, or sell $10 worth, and I could get that at a fraction and of what the actual asset cost is. Now this means that it is all on their side of the books. This never actually goes to NASDAQ. Sometimes they, depending on the company, they will send it off altogether as a lump sum, and they'll wait for the right moments. But a lot of times it's all the server side of the brokerage that you're using for the CFDs, and it's all done on their servers. The buyers and sellers are always on their servers. So your price does not actually, the CFDs actually do not change the price of the actual market itself. So it kind of changes the volatility of it, and you actually aren't affecting the volatility of the market shares themselves. And this is helpful in certain cases because it allows you to trade a little bit easier, and you're able to invest with lower amounts of income. So your ROI can be significantly higher because of specific multipliers and leverage used on these CFDs for certain companies, and depending upon the locality that you're using, because your locality also changes what leverage is available to you legally. So say for Forex, if you're trading CFDs of Forex, leverage for Forex, the max leverage is 30-to-1 in Europe and 50-to-1 in the United States. However, in other nations, it could go all the way up to 1,000. Now, a lot of times with these leverages, you are actually technically getting a loan from your broker, and you are getting charged interest. This is normally very important if you are a long-term trader rather than a day trader or swing trader. The loan amount, the interest is normally fairly low, so you normally won't even notice it unless you actually are looking at the very exact details of margin accounts. You won't really notice it. CFDs normally do not work as the same as a margin account. While you have margins for your position sizes, a lot of times you will not be getting a loan. It's just used on their side, such as IQ Options. You really aren't getting a loan, although I think for some of their options overnight they do charge a certain percentage. Do not quote me on that. I'm not 100%. But that's one of the benefits of using fractional stock markets, is the chance to invest in high equity stocks without the need to use the full amount of the stock price. So if you wanted to invest in Amazon, you can invest for far less money. But that's about all I'm going to go over on fractional stock investing, at least for the moment. I would suggest using IQ Options if you're in Europe, maybe stash investing if you are in the United States. I will have a link to both in the description. Y'all have a good day.